What's up, millennials? If you like the words space, 3D printing, and profitable company, then I might have this SPAC for you. Today we're going to look at the exact fair price per share for a company called Redwire. And this is a space company that's also focused on 3D printing, and this is going to be acquired by the SPAC that's currently trading under the ticker symbol GNPK. But before we start, if at any moment during this video you don't really know what I'm talking about, please check out my full SPAC guide that I released a few months ago. Today we're going to be taking a look at method number 1. Also, if you want access to the Excel sheet I'm going to be using today, you can join our Discord for free to get it. You can do so by going to nesami.com/discord, then you can leave your name, leave your email address, and you're going to get access to the Discord channel. And of course, as always, don't trust me, verify me. I'm definitely not a financial advisor. I'm definitely no expert. I am just documenting my journey here on YouTube. So don't copy my numbers as is, but use this method, use your own multiples to come up with your own fair price per share. Redwire is actually a company that's a combination of multiple companies that have been formed in 2020 and 2021. Redwire is a company that is focusing on the space sector, and they are 3D printing materials in space instead of producing them on Earth and bringing them to space. And they are doing this basically for all these sectors in space. It's almost like an ETF, you could say. So if space wins, then Redwire wins, as they say in their investor presentation too. And if you're wondering when the merger is going to take place, we don't unfortunately have a date just yet. Then when we look at the pro forma valuation, we can see that this company, this SPAC, started trading at $10 per share, as is very common, of course, with SPACs. So that's the number you can plug in over here in your Excel sheet. And then you can also see in their investor presentation that they are going to have almost 68 million shares outstanding after the merger. Actually, it's going to be 67.5 million shares outstanding. So that's the number you can plug in over here. So then the Excel sheet is already going to calculate for you the pro forma market cap, which in this case, of course, is 675 million, which is also the number that's over here in the investor presentation right next to pro forma equity value, and equity value here is the same as a market cap. Then you can also calculate the pro forma enterprise value by taking that market cap of 675 million, subtracting the amount of net cash they are going to have on their balance sheet, which we can see is 60 million. And then you're going to arrive at a pro forma enterprise value of $615 million. Thing is, if you go to TradingView, for example, you can see that the company, the SPAC, is currently trading at $10.50 per share. So that's the number you can plug in over here in your Excel sheet. So then the numbers have increased a little bit. The pro forma market cap right now is $709 million, of course, and the pro forma enterprise value is almost $650 million. So based on a share price of $10.50, the company Redwire would currently be worth $650 million. But that is their pro forma enterprise value. We want to know what a fair price per share is, what a fair enterprise value is. So for that enterprise value, what we need to do is we are going to apply a certain very simple method, that is to take the EBITDA of a certain year. In this case, we're going to be taking a look at 2025, so the year 2025. And we are going to apply a certain range of multiples to that EBITDA to arrive at an enterprise value. So we need two numbers. First of all, we need the EBITDA of 2025. And we can see in their investor presentation, they're right now already profitable, actually. They had about $119 million in revenue in 2020, and they were already profitable. They had $16 million in free cash flow. So that's pretty good to hear. Now, if we go all the way back to, or all the way in the future, of course, to 2025, they expect, and of course, as I say in all my SPAC valuation videos, expect is a very important word here. You don't know for sure if this is going to happen, but this is what the company expects to achieve in 2025. So they expect to have a little bit more than $1.4 billion in revenue in 2025, and they expect to have $250 million in EBITDA in 2025. So that is the number we are going to be working with, $250 million in EBITDA in 2025. And then we also need a fair range of multiples, because we are going to apply those multiples to that EBITDA of 2025. Now for that, this company Redwire looks at a few companies that are already quite established in the high growth defense sector. Companies like AeroVironment, Kratos, and Mercury. And we can see that these EBITDA or EV to EBITDA ratios, and again, if you don't really know what I'm talking about, maybe check out my full SPAC guide, but their enterprise value to EBITDA ratios are, as we can see for 2021, 27x for AeroVironment, 39x for Kratos, and 17.4x for Mercury. So that is a range we could be working with to arrive at our fair enterprise value. And that is exactly what this company Redwire is also going to do. Because they say, okay, we have taken a look at those EV to EBITDA ratios of other companies in the same sector right now in 2021, and we are going to apply a certain range based on those multiples. We are going to apply those multiples to our EBITDA in 2025 and then discount it back to the present. So what they came up with is a range of multiples from 20x on the low end, 30x on the high end. And these are relatively similar to the multiples we just have been taking a look at, the other companies in the high growth defense sector. So 20x on the low end, 30x on the high end. These are the numbers you can plug in over in your Excel sheet, of course, right over here, next to low multiple and high multiple. And then the Excel sheet is already going to do a few things for you, because it is going to calculate the future enterprise valuation in 2025, of course, based on these numbers we now have been taking a look at. 250 million in EBITDA in 2025, and the low multiple of 20, high multiple of 30. What the Excel sheet is going to do is it's going to take that EBITDA of 250 million, and it's going to multiply it by 20 and 30 to arrive at a low enterprise value of 5 billion and a high enterprise value of 7.5 billion. Then we can also see what a fair midpoint valuation is, which is basically the average between the low and the high valuation, and that is going to be $6.25 billion. That, however, is the future enterprise valuation. We want to know, of course, what the enterprise valuation would be in 2021. So for that, we would need to discount it back to the present. And for that, we need two numbers. First of all, we need the amount of years to discount it back towards the present. And we also need a discount rate. First of all, let's start with the discount rate, because that is the easiest one. It's going to be 20%, as we have seen in the investor presentation of Redwire, which is also a very common discount rate for SPACs to use. And then we need the amount of years to discount it back from 2025 to the second half of 2021, which is when they are going to be merging. So that is actually interesting, because I think that Redwire might have made a little mistake here, because they are discounting it back 2.5 years in time from 2025 to 2021, second half of 2021. So that would actually be 3.5 years and not 2.5 years. So I am going to be using 3.5 years. They, in their investor presentation, are using the number 2.5 years. Okay, so those are the two numbers we need to discount these numbers, these enterprise valuations, back to the present, back to the second half of 2021. And the Excel sheet, if you plug in a discount rate of 20%, and if you plug in the year we have just been taking a look at, 2025, is already going to calculate the discounted enterprise valuation for you. But I'm also going to do it manually so you can see what the Excel sheet does exactly. So what it does is it takes, for example, first of all, that low enterprise value of $5 billion. It's going to divide that by 1.2. The 2 here is standing for that discount rate of 20%. And it's going to do that to the power of 3.5, and that is going to give you this number, so this discounted enterprise valuation of $2.64 billion, more or less. Then it's also going to do exactly the same thing for the high valuation. So we said that was going to be 7.5 billion, multiplied or divided by 1.2, the 2 again standing for that discount rate of 20%, to the power of 3.5 because of those 3.5 years from 2025 back to the second half of 2021, of course. And that is going to give you this discounted enterprise value for the high end, $3.962 billion. And then you can also say, okay, what is the midpoint valuation? Well, the midpoint valuation for this would be $3.3 billion, which again is the average between the low and the high valuation. But this is, of course, the discounted enterprise value. We want to know what a fair price per share would be in 2021. Well, the thing is, first of all, we need to go back to a market cap. And to go from an an enterprise value to an equity value to a market cap is to take into account the amount of net cash they are going to have on their balance sheet. And we said in the beginning of this video that was going to be $60 million. So what you do is simply take these discounted enterprise valuations, you add back the amount of net cash, and then you're going to arrive at these fair market caps. So for the low end, 2.7 billion. For the midpoint valuation, 3.4 billion. For the high valuation, of course, 4 billion. And then the only thing you need to do is to take those market caps, divide them by the amount of outstanding shares after the merger, which we said in the beginning of this video was going to be 67.5 million shares outstanding. And then you're going to arrive at these prices per share. So for the low end, $40.02. For the midpoint valuation, $49.80. And for the high valuation, $59.59. Now you can imagine these are rather high numbers. Maybe these are not entirely accurate. But these are just the numbers that the investor presentation is giving us. It's not a range that I came up with myself. So you can, for example, decide, well, maybe the range of multiples is a little bit too high. Maybe we should adapt that maybe to, I don't know, maybe 15 on the low end, 20x on the high end. Let's actually make it 20. And then the fair prices per share are going to be between $30 and $40 more or less, which still are pretty good numbers. But I do actually think that this company Redwire is relatively cheap if you look at the valuation, because it has an enterprise value right now of about 650 million, of course. And the revenue for 2021 was already going to be about $160 million. So it's definitely not an expensive company and the way I see it. So according to these calculations, it could mean that Redwire is currently undervalued. But of course, don't trust me, verify me. Always check what I'm doing, check if the calculations are actually correct. And I also would like to encourage you to play around a little bit with those multiples, with the EBITDA, to see what kind of range of multiples you come up with, what kind of multiples, what kind of fair prices you would come up with too. Apart from that, keep in mind that we have been taking a look at assumptions. We've taken a look at a projected revenue number of 2025, a projected EBITDA of 2025. We've applied a certain range of multiples. So if you change one of those numbers, the entire calculation is going to change and your fair price per share is going to change as well. So let me know your opinion about this company. Do you believe this is an undervalued or an overvalued company? Let me know in the comments. And with that being said, thank you very much for taking the time to watch this video, and I hope to see you in the next one. Bye bye!